Here in part 7 of our chapter 2 video, let's talk about the next type of income. That's dividend income. And let's see how dividend income is reported on the 1040 form. Okay, so we're familiar already with this 1040. And here in line number 3, we're going to report dividend income. You notice there's two categories here, qualified dividends, and here off to the right side, ordinary dividends. Again, always keep in mind what we're doing here in this right-hand column is eventually what's going to be included in the gross income and taxable income at the bottom. This information here off to the left side is mostly for reporting purposes. May be taxable, but if so, it'll be included in this right-hand column. So let's talk about how you receive dividend income. To get dividend income, you usually have to own shares of stock of a corporation, a business. And the ownership again is held by somebody called a shareholder or a stockholder. The more shares you own of these stocks, the more ownership you have in the corporation. And if the corporation is profitable, it wants to share these profits to the shareholder. Corporations usually have to pay taxes to the government on its profits. And then when you have excess profits, you want to distribute that to the shareholders. So that's in effect like the same income being taxed twice, once at the corporate level and the other at the shareholder level. So dividends, because of the double taxation, the argument is we're going to be taxing these dividends at a lower tax rate, a lower tax percentage. Most times people make money with stocks when they sell the underlying stock, but it's always nice to get a dividend income to supplement that profit. And the dividend income is going to be reported to the shareholders on this form called 1099 DIV. And maybe the 3 or 4 main boxes we're going to be using here for this chapter 2 is this box called 1A, ordinary dividends, and here box 1B, qualified dividends, and then something called capital gain distributions. Our textbook talks about this amount here in box 3 called non-dividend distributions, and it kind of ties into this capital gains. Most times you'll see this capital gain than this non-dividend distributions. Now, all of this qualified dividends are already included in this first box, the ordinary income. Let's see if I can diagram that out here. So let's say that this whole circle represents ordinary dividends. And then included in the ordinary dividends, or a subset, would be the qualifying dividends. In other words, all qualifying dividends are also ordinary dividends. Or not all ordinary is qualifying, yeah? But all qualifying is ordinary. Or in other words, the number here has to be equal to or less than the number over here. All qualifying is ordinary also at the same time. So you would total up these two boxes, and then back on the 1040 form, here is the qualifying dividends in box 3A. And here in box 3B is the ordinary dividends. Again, the ordinary is going to be bigger than or equal to the qualifying dividends. And the reason why they use the word qualifying, because it's going to qualify for a lower tax rate than all the other income we've been talking about. Okay. If this dividend is a qualifying dividend, the shareholder, our taxpayer, is going to pay either 0% tax, meaning tax-free qualified dividends, or a small 15%, which most taxpayers will use, or the high income taxpayers will be taxing their qualified dividends at a 20% rate. These rates here are going to be lower than the regular rate the taxpayer is going to be paying taxes on their other income. The taxpayer will typically pay a range of 10 to 37% taxes on their other income, and the qualifying dividend is always going to be taxed at a lower rate than the other income of the taxpayer. When we have added up all the qualifying dividends and put them here, and all the ordinary dividends and put them here, if the total of the ordinary dividends is more than $1,500, just like we saw for the interest income, when it exceeds $1,500, we need to list them out on that Schedule B. Yeah, Schedule B. And the first part was for interest that we've already covered. And now here in part 2 is for ordinary dividends. Keep in mind, again, included in ordinary is the qualified dividends. So you write the name of the corporation and then the dollar amount. Yeah, the name of the corporation paying the the ordinary dividend and the dollar amount. And you take a total over here. Again, if it exceeds $1,500, you need to do the Schedule B. Otherwise, you just take the total and just rewrite it back on the 1040 form without the Schedule B. Let me talk about this part 3. The taxpayers we're preparing 1040 forms for are either United States citizens or United States residents. And they have to report on their 1040 all of their income, no matter where it's located, no matter where it's being earned. Could be in a foreign country, which could be easily hidden because the U.S. Treasury, U.S. IRS Treasury may not know about that income. So here they're really asking you, don't hide any money, but telling you if you have foreign accounts, you have to disclose it. Yeah? Yes or yes. And if you don't have any, if you're filling out this Schedule B and don't have any, then you check off the no boxes over here. If you do check off yes, you may need to file additional disclosure forms with the government. Yeah, they call it FBAR. Otherwise, for most people, they don't need to fill this in, but they still check off no, yeah? No. So back to the 1040 form. We just filled out the Schedule B for this total and this total. Now, another amount that is kind of common on the 1099 DIV form is this box 2A called capital gain distributions. So let me illustrate when that happens. Typically, one of the strategies when you invest in stocks is to own stocks in multiple corporations. Yeah? You want to diversify your investments, which is something hard for people who don't know about investing. So what they should do, again, here's our shareholder taxpayer. What they should do probably instead of buying lots of different stocks in different corporations, maybe what they can do is buy shares of stock in a company called a mutual fund or exchange traded fund. Exchange traded funds are probably more popular than mutual funds. And in turn, again, you're buying the stock of that mutual fund or exchange traded fund. And in turn, the mutual fund or exchange traded fund will buy shares of stocks in other companies, like all the stocks maybe in the Dow Jones Index or the Standard and Poor, or maybe all in a specific industry like technology. Now, when these corporations pay dividends to the exchange traded fund, in turn, the exchange traded fund will pay dividends to the shareholder, and that's going to be taxable, reported on that 1099 DIV as ordinary income and qualifying, ordinary dividends and qualifying dividends. Most times, what the shareholder would do is not really take the cash share, but have it reinvested to buy more shares of the exchange traded fund. That's how you can accumulate wealth even faster than having this underlying stocks increase in value. Now, this portfolio of stocks down here may not be something that the exchange traded fund wants to keep forever. So, what they'll do is maybe they'll sell one of these stocks and they're going to have probably a gain on the sale. This gain is just more profit that now has to be distributed to the shareholders, called a capital gain distribution. And just like a dividend is treated as income allocated to the shareholder that they have to report. And again, probably it will be reinvested to buy more shares of the exchange traded fund. This capital gain distribution is taxable. It's reported here in this box, box 2A. And just like the qualified dividend, let's go back and look at that again. This qualifying dividend, capital gain distributions are going to be taxed at these lower rates. And we'll talk about other types of capital gains that are taxable at the end of the semester. But for now, what we're learning in this lecture is the lower tax rates for qualified dividends, the lower tax rates for capital gain distributions, both being reported here on this 1099 DIV form over here, and over here. We saw the qualifying dividends being summarized on that Schedule B, but this capital gain distributions, let's see if we can find it on the 1040 form. Goes here in line 7. Yeah. Now, if there are other types of capital gains that we'll learn about at the end of the semester, you may need to fill out this schedule, Schedule D. But if the only type of capital gain you get is the capital gain distribution, you would just write the total over here and check off this box that Schedule D is not required, but we're still reporting the capital gain distributions. So now you're adding up all your income, including ordinary dividends and capital gain distributions, to eventually get the taxable income number down here that we learned back in Chapter 1. You have to use the tax table or tax rate schedule to get the tax for the year. But I mentioned the qualifying dividend and the capital gain distributions are going to be taxed at lower rates. So you cannot use the tax table or tax rate schedule to figure out the tax on those two items, the qualifying dividend, capital gain distribution. So to make things a little bit more complex, here in the instructions to the 1040 form, we're given a worksheet to use to figure out the tax on qualifying dividends. Not ordinary now, the qualifying part, and capital gains, like that capital gain distributions. So what we're doing, I'm not going to fill in this form for you, but I'm going to describe what it's doing. You're basically putting your taxable income in here. Remember, that's the total income minus deductions. And then we would back out the qualifying dividends from that line back in the 1040 form. And we would back out the capital gain distributions. That asterisk means we're just looking at the capital gain distributions. So we're going to back these things out from the taxable income to get the remaining amount of income. This remaining amount of income, we'll call this ordinary income, not ordinary dividend, but ordinary income, is taxed at the regular rates. Again, either 10 through 37% using the tax table or tax rate schedule. But how do you know if you're going to be subject to 0% tax rate or 15% tax rate or 20% tax rate? for your qualifying dividends and capital gains? Well, it all depends whether this taxable income up here is less than these amounts over here based upon the taxpayer's filing status. If the taxable income here is less than these amounts, that means all of the qualifying dividends, all of the capital gain distributions is going to be taxed at zero or tax-free. Or if the taxable income up here is larger than these ceiling amounts based upon the taxpayer's filing status, then all of the capital gains and qualifying dividends tax at the higher 20% rate, which is still lower than the ordinary tax rates the other ordinary income is taxed at. And if the taxable income of the taxpayer falls between these two ranges over here, within this range, then the qualifying dividend and capital gain distribution gets taxed at this moderate 15%. So on this worksheet, you would figure out the tax at 0 and 15 and 20, and then figure out the tax on the regular income, be it using the tax table, or if the remaining taxable income is over 100,000, we know we need to use the tax rate schedule. Here they call it the tax computation worksheet. I think it's on the next page or some future page in this instruction book. Then you add up all the tax lines over here, and this will be the total tax liability for our taxpayer. Yeah, you cannot just use the tax table or the rate schedule by itself. Yeah. Now these ranges here, from here through here, are adjusted for inflation. So I've kind of summarized it here in this worksheet over the years. Here I'm using the year 2021. And if the taxpayer has a single filing status, and if their taxable income is under 40,400, all of their qualifying dividends, all of their long-term capital gain distributions are going to be taxed at zero. But once their taxable income total goes over this amount and stays within this range, then anything over this for qualifying dividend capital gains tax at 15%. Now, most people don't make $444,000, so their capital gains and qualifying dividends not going to be taxed at this hard 20% rate. Now, what gets a little bit more complicated, and it's on the worksheet, is what would happen if the taxable income falls over this line here, yeah, between this and the qualifying dividends, just takes them over that. Part of the qualifying dividend will be taxed at zero, and the rest will be taxed at 15%. So I have an example here. The taxable income of our taxpayer, including the qualified dividends, is $41,000. And inside of this $41,000 is $1,000 of qualifying dividends. So we back it out, and that means the rest of the income, $40,000, is going to be taxed at the regular rates. Yeah, using the tax table because it's less than 100,000. So here's the tax I found when looking it up on the tax table. Now this $1,000, because we can go up to $400 more, 400 of this 1,000 will be taxed at zero. Yeah, taxed at zero. And then the rest of the dividends, at $600 more dividends, will throw you over into the next bracket of 15%. So here's 15% of that 600. So we add up the tax on the ordinary income. We add up the tax on the qualifying dividends falling below 40,400. And we add up the tax of the qualifying dividends that went over 40,400. And we add all these taxes up, and here's the total tax liability for the year. Again, you have to make sure you're using the correct filing status column. And notice that it's going to be double for married filing joint. Here you look at married filing separate. And in the second row, you notice it's not really double anymore as compared to this. Okay, so look like we even cut it in half. Okay, so you got to make sure you're using the correct filing status and using the correct formula. Again, the formula is basically Um, there's a worksheet here, yeah, inside of the instructions for the 1040 form. I think that's it. Okay, so go ahead and continue into the next video. I think the next video is going to be our last one, covering some miscellaneous types of income.